Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monte, and this is a one-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. If you're brand new to this report, understand that I leave my lines on the chart from last week's report so you can see how the forecast worked out. And last Friday was right here on this green candle, at which time I said we would most likely drop. And I drew this forecast line with the end of the line right there ending at 342.79. So again, if you're brand new, understand that when I draw a line like that, it's the end of the line that becomes the target. And the time frame is not as important, although it could help out quite a bit with option traders to know that by that date, we are looking for that target to hit. And so yesterday, the Dow hit that target precisely, bounced off of this 20-period moving average, and then rallied right up to resistance right here. Now, I want to just take a moment here to explain what's happening. This former resistance is now holding at resistance here and here. Today, we gapped up from yesterday's close, and therefore this gap is remaining open at this particular point in time. Now, next week, I think we could go just a tad higher on the Dow, but then Tuesday, I think we're going to take a big hit, and I'll explain why here in a moment. And that basically is because of the CPI numbers coming out on Tuesday morning, and I'm going to dig in a little bit into that in just a little while. So again, let me draw my forecast lines for next week on the Dow. I'm just basically going to take this straight line like I did last week, maybe put a little bit of a hash mark there, and then Tuesday I expect the market to come right back down close to last week's target, but most importantly to the gap fill target right here. It could break out below that line here on the gap fill, and it could even go a little bit further. I'm going to put two levels of support here. This is a real possibility for next week, believe it or not, with that target at 339.87. I'm being conservative here with this pullback to the gap fill point for those option traders that are trading the weekly options. For those who are trading equities, I would strongly encourage you to trail your stops up, protect profits along the way, and limit your risk to the downside. Again, there's many ways you could do that. I teach risk management skills to our followers through the 1% rule and learning how to spread options as a hedge, but that's a whole nother webinar for that. Right now, I'm looking at the Dow next week going lower. Let's take a look at SPY. This is the S&P 500 ETF. And as you can see right here, as I zoom in, we hit the downside target yesterday, and we didn't gap up, but we set a new high today. Notice, as I erase these lines, you'll see something that might be hard to see with this red line pivot point there. We went slightly higher here on the high, but look, the CCI continues to show lower highs. That is a big fat negative. So for the S&P next week, I'm expecting a pullback right to that moving average, just like that. Not expecting a major collapse in the market like some people might think, but I am expecting a pullback with an eventual collapse in the market. I do not label myself as a perpetual bear, but when you start looking at the economic numbers, you will see that the economy is not looking as good as some may want you to think. And it's getting pretty serious because the numbers are just not matching with what we're seeing in the market. So the pullback for next week, for those that need a target, 428.12 right there to the downside. We have a gap way down here that will most likely fill. And we have another gap down here that will most likely fill. And if I take one step back, again, I want to give you some perspective here. Look at the monthly chart on the S&P. I keep doing that because I want people to understand how significant this wide divergence is from the 20-month moving average. And again, as the price has been going higher, look down below. The CCI continues to show lower highs. It's just only a matter of time before the bubbles within the bubbles start to burst. and the sell-off begins. Now remember, we play both sides of the market. For anyone who's been a follower of mine for any number of years, we make money when the market goes up, goes down, goes sideways. We use option spreads to do that. If you're interested in learning how to do that, just look at the link in the description box, and we'll be sure to have one of our representatives reach out to you to teach you how to enroll in some of these courses that we give. But we are doing extremely well. And next week we have options expiration week, and we're going to be taking in a bunch of cash on our rollouts next week. So it's the most exciting time of the month is the expiration week for the monthly options. So that is the S&P. Now, contrary to that, I'm going to look at the monthly chart on the VIX. All right, this is going back 20 years. Look at that. We're very close to historic lows right here. When the VIX is on the lows like it is right now, that becomes very bearish because that tells us that the investors are relaxed with their long positions. They're not selling. They're not really buying too much. They're just relaxed. There's low volatility. They're enjoying profits at the highs. But guess what? When the VIX starts to move up, like it did yesterday, we came very close to hitting that target. I am not touching a single thing on this VIX chart. I'm leaving that target in place with the ultimate target up here right around 22.21. 2 weeks ago, I put that as a hard line target. I'm going to leave that in place until it hits. So for those of you that trade VIX options, that's a good indication for you that we could possibly turn up towards that level. I'm even going to go so far to say that we could even go up to 26 on the VIX. Now, this red candle tells us there's still some downside momentum. So I wouldn't be surprised if Monday morning we go lower, and then towards the end of the day on Monday we start to go up, anticipating higher inflation numbers on the CPI coming out Tuesday morning at 8:30. So that's the VIX. Nothing's changing there. Just leave that right in place. Now, if we look at IWM, here's another market that hit the target right on the money. We actually blew through that target, hit this support level. Like I mentioned last week, that is a key support level. We touched it and then bounced from it. Look at that. Exactly at my target price for Friday here, July 9th. Now, what does that mean for next week? This whole area up here, let me erase this because I have to redraw this for you. The moving average and the 50-day moving average, which I'm not going to put on the chart, but the 50-day moving average brings us right around 226. The market is now below those moving averages. So these moving averages, the 20 and the 50, are going to act as resistance. This former trend line, which could also be drawn as a channel line, was met today. See, this back here was former support along the way here. Support, I'll draw a little S there. Support here. Held support for 1 day, broke support. Now this support has reversed its role to become resistance. This is a concept that I teach. Role reversal, they can do it in horizontal lines, trend lines, moving averages. It's all the same. The role reversal is when support switches to resistance and vice versa. You can trade off of those numbers. They're very reliable. The other thing that I want to mention here before I draw my forecast line is that if you look at the volume down below, we had a higher high today, but we had 40% less volume than yesterday. So it's telling us there's no follow through there on the Russell 2000. So I think we're going right back down. I'm going to be a little bit more aggressive here, saying that we're probably going to reach beyond this low from yesterday with the downside price target on IWM at 217.38. Now that brings us to the Qs, the tech sector. We had a rotation. Investors are moving into tech. We did not hit the target yet. Came very close to that yesterday where we came halfway to the target. I'm leaving this exactly the way it is. We still have a wide divergence here. We have a drop in volume on the way up. We have oscillators crossing on stochastics that are a sell signal. And guess what? Yes, another negative divergence read on the CCI. So I'm leaving that right in place. Target still intact at 349.25. My recommendation is that you protect your profits. I'm going to say this over and over again because repetition is the best teacher. Protect your profits and limit your downside risk. Don't think that this bull market is going to last forever and ever. When the higher it goes, the more severe the sell-off is going to be. And I am telling you, you could make more money faster on the way down than on the way up, because that's when fear starts to take a hold of investors, and we a lot of times get that capitulation that drives prices down very quickly. Now let's talk a little bit about the CPI, and then I'm going to wrap this up. If you look at what's happening in the economy, this is a long-term chart of the labor force participation rate. Now, let me explain something to you. I'm not an economist, but I could read charts. The labor rate right now, which is right here, I'm going to draw that little arrow, is in percentages the same place it was when I was graduating high school, right back here. You see that? We are right back where we were in percentages of the labor force at work, right where we were from 1976. Now, the numbers that come out and the reports that are put out to the general public might make you think that, oh, all is great with the economy and things are just fine because we're trudging along under this recovery. Well, guess what? We need 1 million new jobs per month for a whole year just to get back to where we were pre-pandemic. And we're not even close. Not even close. You can see that from 2016 right here to 2020, we had an uptick in the percentage of people at work in the labor force, but then dramatically dropped in the pandemic months right here. And we're not even close to getting back on track. That's number one. Number two, you have more people that are out of work. And we're hearing from all the economic cheerleaders that, oh, we are creating jobs. Well, really what's happening, if you look at this number compared to new jobs being created, this just means there are more help wanted signs out there now than ever before. There's lots of jobs, but guess what? People aren't filling those positions. So that's something to keep in mind, because if they're not filling positions, they're sitting on their rear collecting the stymie checks from Uncle Sam. September could be an interesting month to see just how many people scramble for those open job positions. But that's a long time between now and then, and that could still put a big hurting on the economy when you look at the numbers. Now, let's look at some more numbers. This is the Consumer Price Index. This is a chart going back to May right here, and you can see we have these numbers oscillating. But right here, last month, we had the numbers come out at 0.6% increase. I'm expecting that to triple. I'm expecting a 300% increase in CPI numbers, which will put us in the danger zone. I've highlighted this on the chart. Those numbers will be released on Tuesday at 8:30 a.m. What does that mean? Well, the markets aren't open then. Unless you're trading pre-market, it's going to be hard for you to participate. So Monday might be your day to wholeheartedly embrace risk management and an effort to limit downside risk and to protect any profits that you have while we're hovering at these highs. On May 21st, I'm going to say it again, I called the beginning of a topping pattern. I called the top. I did not call a high. Those of you who listen to me very carefully understand that. I did not call a high on May 21st, and I said that we have time. Why? Because when you form a top, and let me use the IWM as an example here. This is a weekly chart. When you form a top, and let's say this becomes a double top, it doesn't happen in 2 or 3 weeks. It sometimes takes 3 months. On average, a head and shoulders pattern or a head and shoulders top takes about 3 months to form. Now, if this is a double top, or some might even call this a slight M top here, right? You have this M pattern forming. It's at the bottom of this M, or the base, that becomes the trigger point for the top to be completed and the sell-off to begin. Now, for our members, I have a trigger point at 210 on IWM. Why? Because that correlates to the bottom of this pattern. So the instructions are going to be automatic for our members. If we close at 210 on IWM, get out of all long positions, get out of any long positive delta option positions, and we're going bearish all the way. Right now, we're enjoying this price range. We're collecting premium on the option spreads, and we're really having a great time. But I'm just putting that word of caution out. We break below 210 on IWM. Sayonara to the bull market, and hello to the major grizzly bear market. So that's all I'm going to put out right now. Please like and share this video. Thank you for all the comments, by the way. The more comments that are made, the more interaction, the more it gets noticed on the search engines. Appreciate that, and you have a great weekend. So long.